Welcome back. In this section, what I want to do is talk about the costs of pricing, the costs involved in pricing, and how we use it as partially setting a price. Then what we want to do is some calculations. We're going to take a look at how to figure out the retail price or the sale price given a couple of pieces of information, and we'll take a look at the break-even piece as well. So let's start off with some real basics. And what I thought I'd do for this piece is I brought out that chart that I talked about before. Okay, let me just bring this out here. Hang on. Okay. All right, and this is an example. Now, in this case, this is the same one I gave you earlier in the course. It's an example, but I've only got percentages in this case. So what I thought was we take a look at revenue as price times quantity, and that's going to be equal to 100%. Then we've got the cost of goods sold, and that's going to be a variable cost because it varies based upon how many units we're selling, based on a variety of things, okay? Although based on a variety of things, it varies. That gives us the gross margin. Then we've got sales and general administration costs, all of our fixed costs, and a net margin. This one is kind of common for a manufacturing firm or even a restaurant, okay? So what we see is SG&A, our sales and general admin, is our fixed costs. We've got our variable cost of goods sold. We've got our two margins, our gross margin at 70 points and our net margin at 10 points. Okay, armed with this, we can make some calculations, okay? Now, the first one we can do is we can figure out what our markup is or what our price should be if we know our markup. So we can take all those percentages effectively and with one number, populate the entire field. So let's take a look. If we take a look at markup pricing, which works on this methodology, okay? Oops, hang on. Markup pricing says you set your sell price is equal to your variable cost, which in our case is cost of goods sold, divided by 1 minus the gross margin percentage, which is how much you want to make on the gross margin. Well, if I give you an example, and we talk about the cost of goods sold is $10, and our gross margin is 50%, what's our price? Well, it's 10 divided by 1 minus 0.5, or $20. What most students do is they take 10, multiply it by 50, 1.5, and they go 15. No, that's not it. That's not the markup, okay? You want to use the gross margin to calculate the markup in this particular piece. So remember, it's price is equal to your variable cost divided by 1 minus your gross margin, okay? Hang on. Sale price is equal to cost of goods sold divided by 1 minus your gross margin as a percentage, okay? And that gives you, in this case, 50. In our case, we're using 50. And we've got a $20 gross margin, or sorry, $20 sell price. Now, if I change that to 60, I get a completely different number. So let's say I decide to go and change that to 60, and because I hadn't done it ahead of time, I'll just go get my handy dandy calculator out here. And we're saying, okay, we want a $60 or a 60% gross margin. Well, now what we've got is a $25 sell price. Now, if we only want a 40%, well, then what we've got is a 1667. So you can see how just changing our gross margin we're expecting really has an impact on what our price is. Now, if you're in an area where your gross margin is going up because your unit costs are going up, that's when you start to see price squeezes. Because what will happen is, remember that status quo pricing we talked about? People don't want to raise prices. And we're in that kind of environment right now. Nobody wants to raise prices because they're worried about consumers not buying the product. So everybody's holding steady, and what that's doing is it tends to crunch their net margin. Now, that's not true of everybody. Some companies don't care. They raise the price anyways. We're starting to hear rumblings. We're going to see this in a variety of industries. Okay, electronics for one, which has been kind of holding the line for a while. Airfares is another one, although that's being driven by fuel. So that's a very, very interesting one to look at and usually why in the aviation industry we always look at their cost structure ex fuel, excluding fuel, and then we look at it with fuel. Okay? But anyways, we do see that. All right, what's the next piece? Well, we've got break-even pricing. And in break-even pricing, let me just take a look at that. Break-even pricing basically tells us how many units we need to sell to come up with a zero profit, okay? Because we don't want to go below that number, and we sure would like to be above that number. So if we take a look at break-even pricing, the break-even pricing basically says we take our fixed cost, divide it by our price minus our variable cost, and that will tell us how many units we need to sell. So if we figure out that, let's say in our example, and we're going to use our SG&A, our SG&A is 100,000, and our price is that 20 we've just calculated out, and our variable cost is the $10. How many units do we have to sell? Well, we can figure it out. So we take the break even is equal to 100,000 divided by 20 minus 10, or 10, and we come up with 10,000 units. Okay, so there we go. So our break even in this case took our fixed cost, which we say is 100,000. We take our price of 20, our variable cost of 10 gives us, and we calculate out the break even, 100,000 divided by 20 minus 10 gives us 10,000 units. Now, sometimes we don't want to break even. Remember, some companies set a profitability. So you can change break even to account for profitability. So let's say, for example, that the question is not what point do we break even. The question is what's quantity at 100,000 profitability. Okay, so now we've got our example of the 100,000 in SG&A. The price stays the same. The variable cost stays the same, but we're adding in a new one that our target profit, remember we saw that from the first area of one of the things we can set. Our target profit is now 100,000, which I'm going to call 100K. So our new quantity, our quantity at 100,000, or profitability, is now 200,000 because we have to add the fixed cost and the profitability to it, because the profitability is in a sense becoming a fixed cost. We have to cover it because that's our goal. And if we do that, we find now we're at 20,000 units. Okay, so we've got to sell 20,000 units. Now that was an easy one because it was a straight doubling. But we can do the same thing. So a good test question is always, okay, you've got a company, here's their fixed cost, here's their target profits, here's their price, here's their variable cost. What's the number of units they have to sell to make that target profit? Okay, great test question. Usually preceded by, here's the variable cost, here's their margin, figure the price out. So you're going to have to do some calculations. So again, for the next test, be sure you bring your calculator because you will need it. Okay? All right. So that's kind of the cost side of pricing. Very big. Some contracts, by the way, are based upon cost. You'll hear about fixed cost contracts or fixed price contracts. That assumes there's a certain price or a certain cost structure. And the company has said, yeah, we can hit that price. And if they can, then we can hit that cost structure. That price will give them the profitability they're looking for, their targeted profitability, okay? So in a fixed price contract, what they're banking on is they can hold their costs down. The other one you often hear, especially with a lot of high-tech development, military contracts, NASA, is cost plus. If there's a lot of unknowns, what they'll do is the contractor will be paid their cost back plus a percentage that's perceived to be a realistic profit for them, okay? They're trying to do away with those just because they thought that contractors were running up the price, for no good reason. Okay, what else impacts price? Well, the product life cycle. We saw that. As you go through the product life cycle, your price is going to start to drop because more competitors are coming in to the marketplace. You're getting in deeper into the customer base where they don't have as big a need, so they're not willing to pay as much. They're not willing to sacrifice as much. Okay, so the product life cycle. The competition, the more competitors you have, typically the more in price, the more in check your price is kept. Whenever there's a merger, one of the big fears is that the new bigger company will start to raise prices because they can, and there's no competitor to keep the lid on them. Okay, there's none of the invisible hand that Adam Smith talked about. So usually the more competitors, the more the price is kept low. You see that in commodities. No one producer can really impact the commodity price. So that's really designed to it stays as low as it can. And sometimes that's helpful. Sometimes it's hurtful. Those of you who come from agricultural backgrounds will know that sometimes low commodity prices are really bad. And sometimes they're just okay. Okay? Your distribution strategy plays a role in your pricing. Some companies want to have differential pricing in different areas to reflect the type of distribution they have. Okay, whether it's intensive, if it's into a particular target group, but they've got another target group that can use it as well. Those have an impact on your distribution strategy. If you want to get extensive distribution, you tend to price lower. If you want to have more selective, you tend to price higher. If you tend to have different target groups that are using the same product for different areas or different uses, you might have differential pricing for it. Okay, all of those come into play in the distribution strategy question. Your internets and extranets, especially in B2B, the big trend today is online auctions and what are called reverse auctions, where a company will say, we're looking for this part and here's the most we'll pay for it. And then companies try and make sure they can charge the lowest for that product. Okay, you do the same thing with your Priceline, with your Kayak, with any bot you have that goes out and finds different prices for hotel rooms, airfares, whatever. That's a great example of why you want to keep your pricing down, because it's easier than ever today for consumers to find out the price of your product. You can compare Amazon and eBay if you want. Gary Vee, the marketing guru, who I've got a video for you to watch after this, he's big into, look, you want to make a few bucks on the weekend? Go to a garage sale. Buy stuff at a garage sale, sell it on Amazon. Now do your homework first. Find out what's selling on Amazon for what price. Go and find it at the garage sale. You're making money with what is called arbitrage, the difference between. We're buying in one market, selling in another. Okay. Your promotion strategy. What's your promotion strategy? How are you promoting your product? Okay, that'll impact your price too. If you're not doing a lot of promotion, you keep your price low because that SG&A, which is where your promotion's paid out of, that's a lower number. Okay. The demands of large customers. Sometimes large customers really keep the lid on price. Walmart's famous for that. If you take the retail class, we'll talk about more about that, and the Vlasic pickle example, which almost bankrupted Vlasic pickles because Walmart was keeping their price of the pickles really, really low to the point where Vlasic wasn't making money. And the price-quality relationship. Okay, again, what price says about the quality of your product. So if you want your product to be perceived as premium, you'll probably price it above the norm. If you want it perceived as not premium, you price it below the norm. Okay. Now, if you price it below, we always tell people make sure you've got a cost structure to match it, or else it'll be a long, hard ride to bankruptcy typically. Okay, we take all these things into account. We want to set the price. Well, we set our pricing goals. Is it sales? Is it profits? Is it status quo? What do we want to do? That's number one. We estimate our demand, our costs, and our profits. Okay, so we have to estimate our demand. Where do we do that? Well, that goes back to marketing research, where you go out and you talk to customers and you figure out who's moving through that sales funnel. Okay. You estimate what are your costs. You talk to your suppliers. You figure out what price you can charge. Again, based upon what you think what you're looking for, and a profit. What's a realistic profit at your stage of development in your industry for a product like yours? All research you have to do. Once you've got that, choose a pricing strategy. Do you want to skim? In skimming, what you try and do is you're trying to profit maximize. So you charge as much as you can on each layer and you pull that off, okay? We see that a lot in electronics, especially when they first come out, really expensive, because those are the people that have, again, the people that are buying them at that point have the biggest need. Take that away. Go to the next level. Charge them as much as they'll bear. Take that away and keep doing that. That's called skimming. Sometimes it's called peeling the skin off the onion as well, okay? You can try penetration pricing. Penetration pricing says set your price as low as you want to get the maximum distribution. That's tied into your distribution strategy. What you're trying to do, get a share advantage. You're trying to get as many units sold as you can. Okay, sales maximization. Or do you want to do status quo pricing? Do you want to come in and not rock the boat? Most companies, unless you're really big, don't use status quo pricing because status quo pricing does not set you apart from anybody. And if you're a new company and you come in and you're exactly the same price and nobody knows who you are, chances are nobody's going to buy your product, or very few people will buy your product unless you've got a lot of promotion money, in which case you're probably not going to have it because the status quo pricing is probably based on somebody who's more in the mature stage of their market where a lot of their costs are paid off. Yours are just coming in. So again, set your pricing goals. Estimate your demand, your profits, your costs. Figure out your pricing strategy. Do you want to make the maximum amount on each unit, or do you want to sell the maximum number of units? First one's skimming, second's penetration. Or do you want to hold the line, and that's status quo pricing, but be aware there's all sorts of issues related to status quo pricing. Then there's some legalities of price strategy. Remember I talked to you about the fact you can't sell for less than your cost of goods sold? Okay, because that's considered unfair trading practices. That's one, okay? So you can't use price as a weapon. Now that's tough to prove, by the way, okay? So we can say this all we want, it's tough to prove, all right? Unfair trading practices are really difficult to prove. And we're seeing that right now in the trade tiff that's going on around the world, because what we think of as dumping, if you manipulate the numbers a bit, isn't dumping any longer, okay? It's also illegal to fix the price. Now you're probably saying, what's the difference between status quo pricing and price fixing? Well, price fixing is the various competitors get around and go, tell you what, let's set the price to this. That way we all make this amount of money, okay? They formalize the agreement. OPEC, the Organization of Petroleum Exporting Countries, tends to do price fixing. They try and set the barrel of oil. Now, the problem is, once you start getting some new players involved who aren't part of the cartel, price fixing tends to fall apart. Price fixing never lasts a long time. The biggest case of price fixing in the US involved Archer Daniels Midland, ADM, and a particular microbe. And ADM and some, I think it was Korean companies, got together and fixed the price on this. The Justice Department found it out, busted them. The CEO of ADM ended up going to jail for it. It did become a major motion picture, and I'm blanking on the name right now. But it was a mess. So that's price fixing. Status quo pricing is where people look around and go, okay, I don't want them to get an advantage. So what I'm going to do is I'm going to make sure I price at their level or close to it. If I'm higher or lower by just a bit, it's not going to be enough to get customers to move because it's in the price inelastic zone. Okay, so you do see kind of that price fixing. Price discrimination is another one. You can't discriminate based upon something you can't show realistically and legitimately causes a different pricing model to be used. Okay? So usually when you see price discrimination, it's based upon cost. I can service this customer less for less. My fixed costs are lower, therefore I can charge them less. Or it's based upon market conditions. Walmart uses this, where they'll price diapers, for example, at a lower price in lower socioeconomic areas because what they're trying to do is capture share in that area. And that fits with their EDLP penetration style pricing model. Or because of the competition. Okay, so in area 1, I'm making 20% profit because I don't have any competition. Over here, I've got a couple of competitors putting downward pressure on pricing, so I'm going to make less there. Okay, those are all perfectly legitimate forms of price discrimination. If you use, and they're all kind of what are called second degree forms of price discrimination. Primary price discrimination is generally illegal, and that's I won't sell to you because. Okay, that's considered to be illegal. It could be based upon your gender, it could be based upon your race, it could be based upon your university background, whatever. You can't do that unless you can prove that there's a legitimate reason why you're selling to one customer for a different price than another one. You can't do it under the law. Okay, that's the end of video 2. What I've done now is I've posted a video by Gary Vee, who I mentioned before. If you haven't seen Gary Vee before, he's a well-known marketing guru, entrepreneurship as well. That's the good news. The bad news is Gary Vee's a little rough around the edges, so he's going to drop some nasty language. If you don't like nasty language, my apologies in advance. But he does have a strong message, especially when it comes to millennials. So watch the Gary Vee video, then come on back and we'll talk about how to fine-tune your base price.